Hello, traders. It's 8:04 a.m. Chicago time on Thursday, the 21st of February, 2019. Thanks again for joining me today. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. This morning, risk is a mixed bag. We had a nice pop overnight on news. Does everybody know what the news is? At approximately 8:30 Central, 9:30 Eastern, the U.S. and China started drafting six MOUs, Memorandum of Understanding, related to key structural issues in the trade dispute. MOU is said to cover intellectual property, services, tech transfer, agriculture, currency, and non-tariff barriers. So this is the beginning of an actual accord. So the market popped pretty good. It jumped. Let me take a look. I had the numbers here. The ES jumped from approximately 2786, which was basically the SOC on that news, to 2798, stopping just 2 points short of the 2800 century figure. Since then, we have come back to the SOC. We drifted back down right before the European Open. I'll review that. In fact, let me reserve that for later. But currently, gold is off $10. It's the laggard. Bonds are off 22 ticks. So risk on sentiment, sticking over to the risk on sentiment side. It's a mixed bag because the S&P is actually down 6.25 points or 22 basis points. And volatility is down at 15.7, but up slightly at by 13 cents or so. The cable, Japanese yen, Euro Stoxx DAX, and Euro FX are the only ones that are up on my quote page. So overall, it just seems like just mixed bag. Although there are some indications that money's potentially flowing out of treasuries. So and metals. So it'll be an interesting open today. We're opening in range in the S&P. Let's review what we expected yesterday versus what we got. But first, the calendar was super busy today. I mean, holy cow! The German inflation rate came out. Was lower than expected. Well, actually, it's in consensus. It's in line with consensus, lower than previous. We also got the French inflation rate in line. We got Prate, who spoke. We have the German market manufacturing PMI, which came in worse than expected, 47.6 versus 49.7. That's a key figure. We got the same number for the EU. Just a lot of releases. Fed's Bostic spoke at 7:50 a.m. Eastern. We had durable goods, which month on month, which beat. X transports was worse. Durable good orders overall actually missed, and we got a little flush on that. We got 1.2 versus 1.5 expected. Philly Fed also missed at the same time, got negative 4.1 versus an expectation of positive 14. The initial claims came in good, continuing claims came in well, and the rest of it looks like it's ahead of us. So in 15 minutes after the open, we get the U.S. market manufacturing PMI numbers for manufacturing composite services. We get existing home sales at 10 Eastern, and we get the leading index at 10 Eastern. We get natural gas. We get and so on and so forth. We also get crude stocks today, which come out at 11 Eastern because of the holiday. There's a fair amount that's ahead of us as well. So very busy, economically speaking, very busy day. Here's our review. Yesterday, the expected action was, the expected response was that we are likely to push higher, encounter some resistance in the 84, 85 area, and then start to drift down. That did not happen. The alternate scenario was to push towards value low in the prior day's low and then impulse up and then start to drift up until the FOMC, and then from there, it's anyone's bet. Both of those scenarios were way off. Um, I found yesterday to be just not much of a fun day to trade yet again. See, we're trading like it's the summer grind. It's incredibly uninteresting, and as I've told the folks over in the Convergent chat room, it's I'm taking interest in other products, specifically the Russell. Looking at crude again for just short-term scalps and things like that. The IB breakout setup that I talked about on that Futures TV show, which I actually need to circulate, um, that works a lot better in crude than the ES. The ES tends to chop around quite a bit. It works better in directional products, so that's something I'm looking at. Um, Here's what actually happened. Pretty whippy FOMC release. It's going to be hard to look on the Renko because there are quite a few rotations. But here's what actually happened. We just had an open auction in range, completely balanced market, and we start to drift up. We broke the IB high, pushed higher, and then we drifted down and through. We sold down and through and put in a neutral day yesterday. At this point, the day became neutral. Remember that probability historically from January this year to January 5 years ago has a 28% probability that we would break the IB high and then the IB low. And then we continue to drift back through before the FOMC. We take out the IB high again. Just the IB is fairly narrow. Yesterday, it's really only about 6 points. It is narrower than we would normally expect. So that makes it easy to crisscross, but we don't generally see the market crisscrossing back and forth through the IB. It's an indication of wider price discovery in both directions. In both directions, not so much fun. And then right here is the FOMC. The FOMC goes and flashes up to 90.75, then rotates back down, and then comes back to the high side. So quite bullish action as I guess the market's anticipating this resolution on the trade talk. So overall, the profile seems quite well distributed, even for a um, an announcement day. Here's what the traditional market profile looks like. You can see an excess up top and excess at the bottom. Those excesses occurred in the same bracket, in K bracket, okay? The market pushed up and down. That would be these two bars. These are 15-minute bars, and the market profile brackets are 30-minute bars. So K bracket just broke both sides and it ended up favoring the high side and continuing higher. Fairly bullish action there coming into today. It doesn't surprise me that the overnight session went higher, but of course, you know, it's done on news, and then we ended up taking out the SOC of that news. So, tough read. At least for me, I'm happy to admit that I don't know what this thing is doing, and so I'm not trading it much. It just doesn't make any sense for me to stick my neck out, give money away when I don't have a clear picture of what it's trying to do. So here's the overnight. The overnight, we ended up closing at 27.87, opened at that price, and then we started to drift down into the Asian session. It looked like it was likely to come back and retest the 79.50 area, potentially even the IB low at 77.75. And then we got this news right here. That news, again, as I said, is at 86. 27.86 is where the news triggered. And then we ended up popping to 27.98. No, this is an impulse move, no continuation. We expect it to flag and give us a bit of a continuation. No continuation. This is something that we have observed in the S&P lately, it's just, those impulse pullback continuation moves that we see in stocks, we see them in crypto, we see them everywhere. It's just the nature of the market. They're continuously or they're failing at a very high rate in the S&P. There seems to be very little in terms of continuity. The S&P has been doing a lot of this, bop on news or otherwise, then a lot of this, and then a lower high, and then coming back to the middle, and then doing a lot of this. So if you anticipated a short and you took a short and you took a loss, there was just no way to really recover by closing the short, letting it hit your stop or whatever, and then looking to participate in the new trend in the direction of the impulse. The impulse happens and it just kind of drifts. So if you look back at a few days, you'll notice that these impulses are just not following through. So I'm very cautious. I'm more likely to trade from the outside in this market than the inside out, meaning I'm more likely to fade against a pre-designated area. I'm more likely to fade or sell a rally, sell into a rally, or buy into a drop into a pre-designated area. Now, it's not recommended that you sit there and pick tops and bottoms because that's not the intent. That's not the intent of what I'm doing. I'm not going to go pick tops and bottoms. That's an amateur thing to do, and none of us here are amateurs, right? So what I do is I look for areas to trade against, the stock zones, clearly defined areas from prior profiles, fibs, whatever, and then I monitor how it's responding in that area, and then I fade. And I'm looking to mitigate risk, take my risk off fairly quickly, and then let whatever can run. So this is, again, a multi-prong, heavily active price discovery, price value seeking behavior, good volume overnight, far exceeding the prior day, 171. We've been in the 160 to 190,000. Pretty good volume in the overnight session, multiple distributions, and here we are trading at the lower end of the range. We are right here, right now. This is the last print. So we've tested all the way up, and we are back inside, into the lower end of yesterday's range. Hard for me to figure out what to do with that in terms of planning ahead. So I don't have a very strong view on what this market is trying to do. It does seem, based on several factors that I'm looking at, put call ratios, how the VIX is behaving versus the price of the S&P, how much fear or how much is premium being bid up for calls and puts, and looking at where we are now, and it just seems like the market is looking heavy by the longer term participants. Yesterday, very large lots came in and bought the market. Hang on, bought the market, but there were sellers in the morning. So as we approached, so if you look at the yellow line right here, these are very large lots. These are 100 lots or more per tick. 100 lots or more per tick. Or there were sellers in the morning, right? So I'm going to highlight that. There were sellers in the morning, and then they turn around after the European close, and they became buyers. The large lots, which are the participants between 10 contracts and 99 contracts, were selling as well, and it went sideways. And then the large lots and the small lots decided to be sellers all afternoon, while the very large lots ended up buying. The delta was heavy, was weighted heavily to the very large lots simply because of the size that they trade. But overall, it seemed like paper was buying from the smaller participants yesterday, Just it's again, it was hard for me to read given the action. It doesn't surprise me that we finished on the top side, given that how much participation we saw in the order flow by the bigger size. But overall, how does that set us up for today? So let's look at the current market. This is getting a little long. Current conditions. Uh, Currently, I have an even perception of what the plan is likely to be. There's a high probability that the overnight point of control is likely to be touched. That probability in the ES for January this year to January 2014. 5 years of data. Again, past performance is not necessarily indicative of future results. There's an 85, a little over 85% probability that the overnight is likely to be touched. Overnight point of control is likely to be touched. And of course, there's the 97, 98% probability that the overnight high or low, and we are right up against the low, is likely to be touched. So I'm expecting an open auction that tests, uh, oops, an open auction that pushes this overnight low, given the stance of the overnight action so far, pushes the overnight low, impulses back to the overnight point of control, back into bounce for the VPOC, and I'm looking for this market to hold steady here. Yesterday we had about 17 points of range, and that's plenty for today. There are some releases that are coming out today. There's a fair amount of economic data coming out today, but I'm expecting this to stay in range. If anything, so the secondary scenario, the second most likely scenario is not the opposite scenario. It is an open auction that taps the overnight and then just begins to drift through to yesterday's high, holds steady here, and then continues on towards 2800. That's the secondary scenario. It's quite bullish. And then the tertiary scenario, the third scenario, is an open, test up, drive down, hold at yesterday's low, and then I'm looking for a flush down into the Tuesday low, and then a drift down towards the gap. This creates the better opportunity. This is predicated. This scenario is predicated on the fact, on the potential that the market has actually created an excess high for real yesterday. Now look at this area just above the high of Tuesday, 2787.50. It shows multiple tests there, 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 all failing to hold. So that's scenario three is predicated on that testing up, and just the excess continues to prevail, and we turn around, we start to shift down. Now, as it takes out levels below us, yesterday's low, it's likely to flush people out. The market is skewed to the buy side a fair amount. So that's what I'm looking at. Hopefully you've gained something from today. There's a lot to cover. Good luck today, and I'll catch you tomorrow. Take care.